We just got reaction to the U.S. and Canadian jobs data from Kamala Sutton at Scotiabank. For a look at how the markets will react to the news at the open, we now turn to Diana Avigdor. She is Vice President and Portfolio Manager and Head of Trading at Barometer Capital. She is also at the TSX. Diana, thank you for joining us this morning.
Thanks for having me.
What's your early take on, let's begin with the U.S. numbers. What do you think of those U.S. numbers, which were clearly stronger than expected?
It was stronger than expected, but not too strong. As you've seen in the unemployment number, did not go down. It stayed at 7.6%. And I was happy to see that the hourly wages were better than expected, because we want to see in this economic recovery that it trickles down to the employed people. The fact that the unemployment rate did not change, and that's the reason the futures are rallying, it suggests that tapering is not as close as you could have thought if the unemployment rate went down. I think the market's expecting a 7% unemployment rate before tapering commences. And again, the tapering is not necessarily a bad thing. It's quite a positive development going forward. And if it doesn't happen too fast and the patient doesn't get the shakes, slowly we should be okay. So this was a kind of a Goldilocks number, strong but not too strong.
Diana, what's your take on the Canadian job numbers? I mean, essentially flat, and just some of the details I'm seeing that there was a big drop on the hospitality sector, marginal losses in services, and on the weak side there was a drop in the full-time employment, but then we saw a massive gain in the previous month in full-time employment.
That's exactly to your point. It was a great number back in May, and so the expectations for this month were a little more tempered, and the number, I think, came in pretty much as expected. What we have looking forward, though, and I think people are taking this with a grain of salt and trying to overlay some numbers as to what happened in the Alberta flooding and Quebec construction strike. So those numbers are going to be coming out for next month. So there is less attention being put on this particular number as people try to put in those effects for next month that came out after the survey was taken.
Back to the U.S. now. How do you expect U.S. stock markets to react this morning? We've seen a bit of an uptick in the futures markets.
Right. The futures have also reacted yesterday to the surprisingly dovish Bank of England and ECB. And so we are up, I think, 3 or 4 extra points on this number. I think that the U.S. market will be characterized, first of all, bottom line, this is good. And looking out forward, it's very good that the economy is slowly repairing itself, and the unemployment numbers are showing this. However, I think that the risk and what might create a lot more volatility in the next month or two is the fund flows. We've had a huge bond bull market with amazing 5-year flows into the U.S. bond market. And as we're normalizing, and emphasis on normalizing, you will see some bond outflows. And as a trader, I've learned never to underestimate the flows, which can be so big and can create a little bit of volatility, especially when it's in the bond market. A lot of people think that bond markets, when you invest in a bond fund, you're going to be safe. But bond funds are extremely volatile, and that tends to shake some people. So I'm expecting a little more volatility going forward, despite the fact that from a macro perspective, it's all looking good.
Diana, when you see this money flowing from bonds into equities in the U.S. market, do you still see value in certain sectors in the U.S.?
Well, certainly what this underpins is the fact that you as an investor have to pick your sectors. It will not be enough for you to invest in the index, as the index is going to go up and down as a composition of all sectors. You will have to pick your sectors. The sectors that tend to benefit, especially in this in this part of the cycle, and as rates start going up, it's not always bad for all sectors. Rates that start going up at this stage of the recovery, meaning the beginning, will benefit some sectors, such as the economically sensitive sectors, some industrials with scale and large caps, particularly to keep you safe. The financials initially might benefit. Large cap tech that pay out that are starting to pay out dividends, or companies that increase their dividends throughout this cycle. And sometimes, yes, margins might contract, but top-line sales start growing. And a lot of these large cap techs have a lot of cash. And the psychology in the market now, and the benefit that companies want to give their shareholders, is through the dividend payout, and they want to grow their dividends. There used to be a time when there was the psychology that if you paid out a dividend, it meant you didn't have any other investments. But today, right?
Yeah.
Today, it's not the case. Today, people want to get paid. And with our population and demographic situation the way it is, people need income. So equities are starting to take the place of those safe bonds.
Thanks a lot, Diana. That was great insight moments after the release of that jobs data in the United States.
Thanks very much for having me.
That was Diana Avigdor. She is Vice President, Portfolio Manager, and Head of Trading at Barometer Capital. She joined us from the TSX in Toronto.